Welcome back to Iraqi Dinar Updates, your trusted source for clear, insightful analysis on global finance and the Iraqi economy. If you're serious about understanding how the broader economy impacts the dinar, today's topic is one you don't want to miss. Let's dive into the world of monetary policy, what it means, how it works, and why it matters to every citizen, investor, and policymaker. Monetary policy is one of the most powerful tools in macroeconomics, shaping the direction of a nation's economy. It refers to the process by which a country's central bank, like the Central Bank of Iraqi, manages the money supply and interest rates to achieve specific goals. These goals typically include controlling inflation, stabilizing the currency, fostering employment, and supporting economic growth. While fiscal policy involves government spending and taxation, monetary policy deals with the flow and cost of money. At the heart of monetary policy is the central bank. In Iraq, this is the Central Bank of Iraq, or CBI. The CBI's role is not just to print currency, it's to maintain economic stability. To do that, they rely on different tools, including setting benchmark interest rates, conducting open market operations, and managing reserve requirements for commercial banks. By using these tools, the central bank can influence borrowing, lending, and spending in the economy. Let's break it down. When the central bank wants to stimulate economic growth, especially during periods of slowdown or recession, it may lower interest rates. Lower interest rates make borrowing cheaper. Businesses can take loans to expand, and consumers can spend more easily on homes, cars, or other goods. This increase in spending helps drive demand, boost production, and ultimately create jobs. This is called expansionary monetary policy. On the flip side, when inflation is rising too quickly, meaning prices for goods and services are increasing at an unsustainable pace, the central bank may raise interest rates. Higher rates make borrowing more expensive, which slows down spending and investment. This helps cool off demand, which can bring inflation back under control. That's known as contractionary monetary policy. Another important tool is open market operations. This refers to the central bank buying or selling government securities in the market. When the central bank buys securities, it injects money into the banking system, which increases liquidity and encourages lending. When it sells securities, it pulls money out, tightening the money supply. Reserve requirements are another lesser-known but impactful tool. This is the minimum amount of money that banks must hold in reserve, rather than lend out. If the central bank raises reserve requirements, banks have less to lend, which slows credit growth. If it lowers them, banks can lend more, which stimulates economic activity. So, how does all of this connect to the Iraqi dinar? Well, the health of Iraq's economy, inflation rates, oil revenue, and foreign reserves are directly affected by monetary policy. The Central Bank of Iraq must carefully balance all of these forces. For example, if inflation starts rising due to higher import prices or currency fluctuations, the CBI might consider tightening monetary policy to protect the value of the dinar. In a country like Iraq, where the economy is highly dependent on oil exports and foreign currency inflows, monetary policy becomes even more delicate. The central bank not only has to consider domestic factors but also global oil prices, U.S. Federal Reserve decisions, and regional economic conditions. Because the dinar is not freely floating and has a managed exchange rate system, the central bank also uses monetary policy to support the official rate and minimize speculation in the black market. A great example of monetary policy in action was during the years when the dinar came under pressure from internal and regional instability. The central bank had to work hard to maintain confidence in the currency by using its foreign currency reserves to stabilize the market. It also had to control inflation, ensure liquidity in banks, and coordinate with the government to ensure smooth budget execution. Monetary policy is not a quick fix. Its effects can take months to filter through the economy. That's why it's important for central banks to look ahead to anticipate inflation or economic slowdown and act proactively. They also need to be transparent so that businesses and investors understand the direction of policy, which helps stabilize expectations. You may also wonder, what's the role of international institutions like the IMF in this process? Well, for countries like Iraq, especially those recovering from conflict or transition, institutions like the International Monetary Fund often work with the central bank to build strong, independent monetary frameworks. They advise on interest rate policy, inflation targeting, exchange rate regimes, and financial regulation. This helps countries like Iraq avoid extreme volatility and ensures that the monetary system supports economic stability. One major challenge for any central bank, including Iraq, is balancing monetary policy with fiscal policy. If the government is overspending or running high deficits, it puts pressure on the central bank to print more money or keep interest rates low, which can lead to inflation. This is where policy discipline is crucial. A strong monetary policy must be backed by responsible fiscal behavior from the government. Another key point is public confidence. A central bank can only be effective if people trust it. If people believe inflation will rise, they start spending quickly, which fuels even more inflation, a phenomenon known as inflation expectations. On the other hand, if the public trusts the central bank to keep inflation low, they behave more moderately, which actually helps the central bank succeed. In Iraq's case, building that trust has taken years. The CBI has made progress through reforms, digital payment systems, tighter banking regulation, and better communication. But there's always more to be done. Monetary policy is not just about economics, it's about psychology, credibility, and long-term vision. So, when we talk about support and resistance in currency markets, or we analyze inflation data, or we see interest rate changes by the central bank, all of that is tied directly to monetary policy. It's the invisible hand guiding the economy, shaping the dinar's value, and influencing the decisions of every bank, business, and household in the country. That wraps up today's deep dive into monetary policy and its impact on Iraq's economy and the dinar. If you found this breakdown helpful, don't forget to like the video, subscribe to Iraqi dinar updates, and turn on the notification bell for real-time analysis and market insights. Stay informed, stay sharp, and as always, a thank you for being part of this growing community. Until next time, take care and keep watching the market closely.